All right, so you're here because you want to learn about investing in the stock market. Now, my guess is that you want to get out of this 9 to 5 grind, this almost modern slavery of just working to live paycheck to paycheck. And instead of working for money, you want to learn to have money work for you using stocks and the stock market. So I believe that right now is one of the biggest opportunities to build wealth in the US stock market. And the reason why I say this is because we are now seeing the growth of the biggest working population in the United States, which is the millennial generation. Now, that's going to drive growth in businesses, in the economy, and in savings and investings. And so that what that's likely going to do is create a 10-year opportunity for huge wealth creation in the stock market from 2035 or all the way to 2035 to 2038. Now, I started from nothing. I taught myself finance. I became a stock analyst at an investment bank. And by applying the knowledge that I learned of investing, I ended up owning hundreds of thousands of dollars worth of stocks in just a few years. Now, the thing is, this was a long journey because when I first started out, I was just a kid moving to New York City. I had nothing but dreams. I knew nothing about the stock market or finance. So when I first started investing in stocks, I would just buy things at random. I would hear about a hedge fund buying a stock. I'd buy it. I'd see a chart of a stock going up. I'd buy it. I'd see a stock mentioned by a guy writing a newsletter. I'd buy it. Now, guess what happened? I just lost a lot of money early on. And I made a ton of mistakes, like trying to time the market or selling too soon. And these mistakes probably cost me the equivalent of millions of dollars in lost opportunities. And it was only after working for a few years in finance that I finally learned how to invest properly with a proper plan and proper strategy. And that's how I was able to start saving just a small percentage of my salary and build it up to hundreds of thousands of dollars. And so that's what I'm going to teach you here so that you can avoid all my mistakes and build your own portfolio to reach your goals. And look, I get it. The stock market can be really scary. You never know if you're going to lose all your money in a market crash. So I'm going to help you understand how the stock market works and teach you the strategies that professionals use to reduce their risk. So in this ultimate beginners video, I'm going to be sharing with you everything you need to know to invest in the stock market safely and make money. Now, this is going to include things like mistakes to avoid, the strategies to actually build your wealth, the steps of financial planning, all of it so that you can build a stock portfolio that's suited to you. And we're going to cover even basic things like how does the stock market work? What products do I buy? And how do I actually trade on a brokerage? I'm going to show you all of these things. So I promise by the end of this, you will have all the fundamental things that you'll need to set up your own personal stock portfolio that'll help you reach your goals. Now, that could be anything like saving for retirement, for your kids, maybe early retirement, or maybe you just want to save for a house, or you just want to be wealthy. So if that's you, get sharp, put away your distractions, and take out your notebook or your phone to take notes, and let's jump right in. Okay, so now let me ask you a question. Would you rather take $3 million upfront or take a penny doubling every day, but for 30 days? Now you might think, well, obviously 3 million, duh. And you'd be right, all the way up to day 29. You see, this is what happens. By day 30, that penny would be $5 million. And so this is the underlying math of why investing is so powerful. It turns a small amount of money into a big amount of money over time. Now, let's take a look at this from an example investment account. Let's say we start with $100 and grow it by investing in stocks. So about a return of 10% every year. Now, someone who invests about $12.50 a month or $15,000 a year will end up with $275K by the end of 10 years. So really what they're contributing is about $200K over that lifetime, and the total savings leads to $275. Now let's look at what happens when someone invests that same amount of money, so $15,000 a year or $12.50 every month, but does it over 20 years. So that ends up with 1.2 million or a little over 1.2 million. And the total contribution is about $550,000 over that lifetime, but the total savings is 1.2 million. So really what's happening over here is you can see that you start to be making money with money. And that's what happens with compounding returns. You see that curve at the end, that becomes more and more meaningful to create wealth. So the takeaway here is you want to start early, investing early as much as possible and consistently as possible. So really just start right now. It doesn't matter what your age is. And then the next steps, which we'll go over, is learning how to target good returns and investing that with time. And that's how you start to see success. So if I could sum up, how do we actually achieve a good result from investing? There's really just a 3-step process that we're going to go through in this video. It's planning, it's thinking, and it's allocating. So when you start to do the planning, it's basically invest as much as you can consistently as early as possible. Hopefully you're starting to get that. The second thing is we're going to be taking a long-term view on our investments in stocks, and there's going to be strategies that you can apply. And we want to be tailoring our investments to our situation and making it easy by automating it. And when I say allocation, it just means what you invest in and at what percentage, and you're going to see that as we go through this video. So let me ask you one last question. Do you think it's possible to retire in just 6 years? Now, I know that sounds crazy, but I did meet a nurse through the education that I do who retired in just 6 years by actively investing in stocks. And this is a direct quote from him. He said, at first, I just wanted to stop working forever. Now, 6 years later, I don't need the job anymore. And one of the things that happened is I 30x'd my money on one stock by learning how to value a business and think long-term. Now, obviously, this is an exceptional case. He took it to the max. He invested everything, almost everything that he earned as a nurse. And he really learned how to invest. He learned how to pick stocks, and he also invested in real estate. But basically, he was all in on investing. And I actually did an interview with him on my channel because I was so fascinated by his story. You can look into that later. But I want to show you what's possible, especially if you put your mind to it. All right, so now let's get into what is the stock market and how it works so you can understand what's going on and how you can get started without making a ton of mistakes. So what the market is, I like to think of it, it's like the dance between the bulls and the bears. Now, what the bulls want is for the market to go up. They're all the buyers. And then the bears, they want the market to go down. They are the sellers. And so when we say there's a bull market, we just mean there's more buyers, and that's pushing the market up. When there's a bear market, it means there's just more sellers, and that's pushing the market down. Now, here is a chart of the biggest stock market in the world that you want to get familiar with. It's the S&P 500 index. Now, S&P stands for Standard & Poor's, and this is a company that creates this index. And what an index is just a basket of stocks. In this case, it's the 500 largest companies in the US market. And what you're seeing is the aggregated price of all these stocks into one single price. So this is a chart of the S&P 500 for the past 70 years. Now, when we talk about the stock market, we can see that we have these bull markets of stocks just going up. And then we also have the bear markets where the prices are generally going down. Now, you notice that the stock market over time tends to go up. And the reason why that is because these companies are growing with the US economy, and you'll see why in a second. And each of these bear markets, so these shaded areas, corresponds to basically recessions in the economy. Now, recession is just when the economy stops growing or starts to shrink. So if we all took this 70-year view, this video could end here. If we look at the takeaway from market history, is that stocks go up and down, and but mostly up. So you just want to buy them because they go up. And you want to be buying stocks and holding them for the long term because we're also in the middle of this 20-year bull market. And you're going to see why again as well. Now, the problem is most investors don't do that, including myself when I first started. I want to show you here a chart from a study. It's from this organization called Dalbar, which basically did a study of retail investor portfolios over the past 30 years. And you can see that the S&P returns about 10% every year. But when they look at actual investor returns, they're getting close to 3 to 4% every year. So what's going on? Why are they underperforming? Well, they looked into that in the study, and it really just comes down to behavior. These were the most common behavioral mistakes of investors that they identified, which is short-term market timing, selling during volatile periods, and chasing performance. So in their study, it would be buying the hot funds. Today, that would be probably buying hot stocks. So what's happening here is that most retail investors are basically self-sabotaging. And so I've also been curious about why that has been happening over and over again for so many years. So let me ask you something. Did you ever think that the stock market is just gambling? Now, I suspect you probably thought that or have thought that the stock market is just a game of chance. You have no idea if the stock is going to move up or down. And so you might as well just bet. You're going to throw some money at some random stocks just to make a bet. There's no thinking involved. You want to chase the action. You see a hot table. You see the market moving up. You want to start putting money there, right? And you want to get together with all your friends and talk about what you're buying. But here's the catch. All of that behavior is the same as gambling behavior, right? Most people treat investing like a casino, and they behave like they're gambling their money. And that's why the returns are so lousy. So here's the same chart again. The one that I want to burn to your mind is, again, it's the S&P 500 index for the past 30 years or so in this chart. So let's really examine what's going on here. So this time we got a blue line over here. And what that represents is the earnings of these companies. You can think of it just aggregated together. This is the profits of the S&P 500 companies. Now, what you can see is that the value of the stock market basically goes up as the profits of these companies go up. But the problem is most people and basically the market of investors kind of act insane, right? They start buying at the wrong times, chasing profits like over here. This is the bubble in the 1998 to 2000 period. Or they sell during really, really volatile periods like over here. This is right around the 2008 financial crisis. So basically, they're buying at the wrong time. They're selling at the wrong time. Basically, they're selling right before the profits of these companies start to go up. So you can see what happens, right? People are buying at tops, selling at bottoms. And again, it's just like gambling. The problem is everyone gets too zoomed in to the period they're in. And that includes myself and other professionals. And so even when you look at a shorter term time frame, a 30-year chart, you can see that generally the stock market is going up. But people get scared. Now, the way that I want you to start thinking about investing is actually thinking about it like risk-taking from a probability perspective. So you're going to be very calculated. If you look at the market, generally speaking, it's going to go up every 6 out of 7 years. And so it's just much more likely from a probabilistic perspective that the stock market will go up no matter what the situation is. And that's because the US economy and other productive economies generally grow and will continue to grow. And so companies are always trying to expand and grow their profits, and that leads to a higher stock price. And that's why the market tends to move up. So the point is, really don't time the market, don't chase, and don't just invest consistently and regularly and stay in it. Now, you might have a problem like I did, is that might be thinking in another way that you're just fearful that the market's going to go down, right? A lot of people get scared at buying at the highs, so they just sit in cash. So here's a crazy statistic that I want to share with you, just to hammer it in that it's almost always a good time to buy stock. So JP Morgan did a study of what happens if you buy stocks at a new high, right? So that's the green bar over here. And so what they found is that if you historically buy at new highs, you actually get a better return than investing on any other day. And this happens right at the beginning of 6 months. And obviously it starts to get higher and higher as time goes on. So the return is actually higher from buying when stocks are at their highs. So again, if you're worried about the flip side, about losing your money because you think the market is too high, well, don't worry. I'm also going to show you some strategies to reduce the risk of loss without doing anything like market timing, and it's also much easier. But again, the point is you want to stay invested. Now, I actually, unfortunately, made all these mistakes when I first started in my experience. So let me tell you about an old story on Wall Street that really helped me change my mindset. So this was probably back, I think, in the 30s or 40s. There was this guy, this husband, who worked at a stock investment company. And so they would put out recommendations of stocks and he would buy them. And he would take, back then you would actually have stock certificates. So he'd take the stock certificates and bring them home. Now his wife would actually put these stock certificates into a coffee can like you're seeing here. So effectively they ignored it. And so 20 years later, guess what? That coffee can portfolio actually outperformed the fund. It grew to about $800,000, which is $8 million today. And really, that's the winning mindset, right? You want to buy stocks, forget them. That's often the best attitude. You want to stay in the market for the long term. And sometimes the easiest way to do that is just to forget what you even own. So I'm going to help you apply this mentality to your savings as well. But first, let's get into the nitty gritty of what actually is the stock market. So what actually is the stock market? It's a bunch of people going around trying to buy and sell shares. And what's actually happening here? Well, a stock is a share of a company. Now, this is an image of one of the original stock certificates for the American Express Company, or Amex. And so what happens is when you buy these shares, you become a part owner of the company. And the value of these shares will go up based on the profits of the company, meaning as the company makes more profit, the value of its shares, the value of the company goes up. So again, the best mindset that you can have as an investor is to start thinking like an owner. So what happens when the company issues shares is typically they do what's called an IPO, or an initial public offering. And that's where the company goes to a stock exchange like the New York Stock Exchange over here, and it lists its stock on the stock market to be traded. Now, the exchange is basically a place where the buyers and sellers can trade these shares back and forth. Now, what actually happens when you invest in stocks is you buy those shares. And the first thing that happens is you exchange the cash that you have for those shares. And it's also called providing liquidity to those sellers, right? Liquidity just means exchanging things for cash. And maybe someone needs to sell their shares because they want to pay for college, or they have a house, or they want to buy a house. And so you give them cash in exchange for those shares. Now, indirectly, what's going on is you are also providing financing to businesses. You're providing them capital to use. And when I say capital, that just means cash that is used by the business to build products, to hire people, in other words, to grow the business. So by putting money into the market, indirectly, it's also going to the company, right? If they sell more shares in another secondary listing, they're going to be raising money. If they pay their employees in stock, and so forth. So they're getting that money to use in some form or another. So the point is, when you're investing, you're also facilitating the growth of the economy. You're participating in capital markets, which is essential to society because you're providing money for people who need the cash, and you're also providing money for businesses to build new products and services and also to grow. So why are we buying stocks now? Well, if you remember what I said earlier before, I believe that there's likely a 10-year bull market in stocks, and obviously a big opportunity to build wealth. Now, why? Well, in one word, it's the millennial. So the generation of Justin Bieber and folks like this are now working pretty hard, right? Maybe your boss right now is a millennial. If, say, you're in the Gen Z or Gen A generation, maybe you just promoted a millennial if you're a Gen X or you're a boomer, or maybe you're just a millennial like myself, and you're working hard right now to make money. You're producing stuff, you're making things, you're starting businesses, and you're making money and saving and investing it. And you're also spending a lot, right? Because you're starting families, you're having kids, you're buying homes. And so all of that leads to a growing economy. There's just more business for companies, and a lot of that money is being earned and saved and invested, and you get more people working, more money going into the market, and all of that drives the stock market higher. Remember, when we have bull markets, it just means there's more buyers. And when there's bear market, it just means more sellers. So what's going on is stock prices, if we start to think about it from that demographic perspective, it tends to follow the trends in the growth of big working populations, big generations of people. So the simple concept is, as generations grow, the stock market goes up. You get more people working, businesses are growing, more people are saving and investing and buying stocks. And that's why we have these long periods of bull markets. And right when the generation starts to peak, so for example, in 99, you got the boomers, Gen X in 2018, that's when we start to have a decline in the number of people in that generation, right? Because people are starting to retire. And so what happens is that it starts to lead to this transitional period. So when we're looking at what's going on right now, we're basically just halfway through the growth of the millennials. And so that should peak around 2035, 2038. And that's when you start to see millennials retire. But in between that period, you're going to be seeing most likely a 10-year bull market all the way up till then. And so that just means you want to be investing now and owning shares of these companies in the stock market so we can ride this 10-year bull market and really build our wealth. So how do we do that? Well, now let's talk about the strategies. So now we're going to get into the nitty-gritty of how we actually invest and how do we do it so that we can both protect our money but also build our wealth using the stock market. So here I'm going to start to share with you the strategies that professionals use to design portfolios. Now, we'll start with assets. Now, assets are just things that you own. And typically when we talk about assets in a financial perspective, it's either things that give you income or things that give you that grow in value. So that could be like rent or interest, or when they're growing in value, it's typically things like stocks. So the first foundation is that every asset has both a risk and return profile. And all that matters is that asset needs to give you some sort of return, and the trade-off is that it has some kind of risk. So when you invest, you can pretty much categorize every asset into like a ladder of risk and return. So as you take more risk, you get more return. So if we start from the lowest risk asset, which is cash, and so that's just money to spend and save with interest, it's very low risk because generally the only downside that you can have is from inflation, from prices going up, meaning your cash declining in value. But it's very liquid, meaning that you can easily exchange it for other assets. So it's very low risk. But the trade-off is you typically have a very low interest rate. Now, as we move up the risk ladder, if you start thinking about it, you can start to lend out your money to corporates or governments, and they'll pay you a higher interest because there's a risk of them not paying you back, and that's also called credit risk. So you get a higher interest rate. You can start to move up, take more risk, and own real estate. So that's property that you own. You can get rental income. That can also grow in value, but then the risk starts to increase, right? You might not be able to get a renter. There's property damage. It might be harder to sell. And so you start to get higher risk, but also a little bit higher returns from either the income or the value. And by the way, real estate investment trusts are called REITs. It's just a real estate fund that you can that trades like a stock, so you can actually buy real estate on the stock market. And then as we get to more risk, the highest risk asset is typically equities and single stocks. So again, these are pieces of ownership in a company that will grow in value or can pay you a dividend. Now, dividend just means a cash distribution that the company pays to its shareholders. Now, the risk, of course, when you're buying shares of a company is that it can technically lose all its value, right? The company can ultimately become worthless. Stocks typically also don't pay you an interest rate. So the returns are higher over time to compensate investors for all that risk. So the basic principle again here is that the more risk that you're taking, the more return. And that's really the trade-off of investing when we're looking at these different assets. So how do we actually measure that? Well, with asset returns, we can actually start to use historical returns, which is just how much it grows in value, including the dividends and the interest, again, historically. And from a risk perspective, we can estimate it with volatility. Now, volatility is just a measure of how much the price moves up and down, which is a proxy, a pretty good proxy for risk. Now, if we're estimating the risk and return of specific securities, and that's just a name for financial assets like the stock of a company, you probably want to be using first principles like the rate of growth of profit for the company, the expected rate of growth, and also an assessment of the risk of the company failing. But since we're looking at assets, right, these are large markets, they have a long history, we can actually use historicals to help estimate those risk and return profiles because it basically reflects the long-term trends in society. And again, this is from a perspective of a long-term investment. So here we have a 100-year perspective of the major categories of assets. We also call them asset classes. We have our returns and we have our volatility as a proxy of risk, again, for the past 100 years. Now, you'll notice that for all these different assets, as you go up in volatility, you start to get higher returns. So the US stock market, that's the S&P 500 over here, as an indicator, has the highest long-term returns. And obviously, that's why we're focusing our investments here. But the risk is much higher. So on an average, we can expect prices to move up and down 20%. Now, when we look at the other asset classes, we got T-bills. So what that is short-term government bonds. That's a proxy for the interest rate or the return that you're getting on cash. Because generally, when you invest in U.S. government bonds, it's considered risk-free from a credit perspective or the risk of the government not paying you back. And then as we move to the more higher risk stuff like 10-year treasury bonds, so that's just a longer term government bond, you get a higher return because you're taking on more risk with a long-term loan. And then the more higher risk stuff would include corporate bonds. So BAA just means it's a rating for a company. So this would be like a B plus company, so a good company. So this is the return for loans for a reasonably solid company. And of course, you got real estate, where you start to get moderate returns and a little bit more risk. Real estate tends to be considered less risk than corporate loans because it's an asset, like you're buying a house versus buying or lending to a company, but it has lower returns. And then finally, when we look at something like gold, well, this is sort of like the return for pure money, right? But it's also very volatile. You can see that it's got a 21% volatility. It's gone up a ton in 2025. But again, this is kind of like a proxy for the interest rate for just global money, right? So this is the high level risk and reward profile of the major assets. That this is just something you want to keep in your mind as the risk and return opportunity for just basic investing. Okay, so now let me show you what it actually looks like when we invest in these assets. So here is the price of the S&P 500, but with a fund. So this is the SPY, which is an exchange traded fund or an ETF. And I'm going to explain to you these products shortly. And so what's going on here is when you the price of the S&P 500 through this fund has gone up about 6 to 7 times in value over the past 10 years or so, right? So that represents about 10% return every year. But you can see that in some periods, it can just drop anywhere between 30 to 40%, right? So that's the risk, right? That's how it gets aggregated into that 20% volatility or 20% range in price. So that's stocks. Now, if we contrast that to government bonds, so this is the 7 to 10 year Treasury Exchange Traded Fund or ETF. So it's holding US Treasury bonds of 7 to 10 years in length or period, also called maturity or duration, right? Just the period of time for those government bonds. And now you can see from a risk and return perspective, bonds went up about 2 times in value, so about 40 to 80. And that represents about a 4% return each year. But the bonds only drop. I mean, if you look at each of these drops, right, we're just talking about 10 to 20% every year max. So overall, that's about an 8% volatility. And so that's what it looks like with bonds. The nice thing about investing is, you don't really need to pick one, right? You can mix and match assets into a portfolio. So for example, if we combined stocks, which is the purple line, and bonds together, which is the blue line, into a portfolio, you can see most of the time stocks are going up, right? And so that's going to drive the value of our portfolio going up. But then when stocks go down, say like in this period over here, you notice that bonds are actually either stable in their value or actually appreciate. And so that helps preserve the value of the portfolio during these volatile bear market periods. And so why am I even talking about different assets if stocks return the most? Well, because when we start to add in something like bonds, it helps reduce our risk in case we want to have access to that capital in that volatile period. It helps us stay in the market. And, say if you want cash to buy a house or whatnot, in that period, you have access to that capital. And so that's why we want to have a mix of assets to keep our portfolio stable. And another thing to keep in mind is that in those down market periods, we can even sell some bonds and buy more stocks in order to get more of that rebound. The key insight here is that asset prices tend to change depending on economic environment. So let's take a step back. In order to really understand the concept of investing in stocks, it might help you to first understand why markets move the way they do so that you can ultimately make better decisions with your portfolio. And so you can really start to think of the economy as just a function of two things. So first is economic activity, right? And so that's just the transactions of buying and selling stuff. So example, if we had a bunch of bars open down the street, you're going to get more drink sales. There's more hiring of staff. They're going to be buying more stuff. And so there's just more food sales, more drink sales, just more activity, more transactions. So that's why it's measured with GDP, gross domestic product. Notice just product, it's like producing. So that's the measure of activity in the economy. Now, the second way to look at an economy is just the price of stuff. So if you think about in that example, we have the cost of beer. Say it's going up from $5 to $6. It's now $10 here in New York City. So that's inflation, right? The prices of these goods are increasing. So even if it's the same transaction of the product, you get a higher price. So that's why we measure it in the change in price. And it's usually something like the CPI or the equivalent, which it measures the change in price in an index. Now, usually when economic activity is growing, that's usually good for stocks and businesses, right? Because you have more activity, you have more sales, more profits. But with inflation, that's not usually great for stocks. For some businesses, it might do well. And so that inflation part starts to change the picture. And that's why when you start to look at an economy, there's actually different kind of states of the economy depending on what's going on with activity and what's going on prices. And you're going to start to see why different assets perform the way they do and why stocks perform in certain environments from these next couple of examples. So here I'm going to give you some examples of different states of economies that depend on the change in activity and change in prices. And I like to think of them like seasons. So these are real examples. So try to imagine, what that economic environment feels like. You can maybe start to think about what economic environment we're in right now and try to guess what assets will likely do well and whether stocks will do well in each of these examples. So let's start with the first one. This is what we call a bust, an inflationary bust, right? Think of a place like Argentina, right? Inflation was just out of control. You have prices just going up like crazy, like these crazy price amounts over here. And economic activity is shrinking, right? We have a recession. People are losing jobs. So not only do you not have money with no job, but prices are going up. So what does that mean? It means your currency is becoming worthless. So when we talk about an inflationary bust, so prices going up and activity going down, kind of think of it like the economy is just spiraling out of control. From an asset or finance perspective, what do you think is going on? Well, if your currency is being devalued, then anything priced in that currency, meaning all financial assets, are kind of basically becoming worthless. Stocks, bond, cash, they're all losing value. So if you want to invest in this environment, you really can't. You have to get your money out of that currency, invest in something like gold or the dollar or the Swiss franc. And that's exactly what happened in Argentina from a market's perspective. let's start thinking about a different boom. So this is where prices are going up, but it's more like with activity going up as well. We call this like an inflationary boom. So think of it like 2021, 2022 in the United States and a lot of other countries. You see prices going up, but there's also a lot of activity. There's a lot of jobs. People are hiring everywhere, right? And the way I like to think about it, like the economy is running hot. People are just building a lot of stuff. And so when you think about it from a finance or asset perspective, where do you want to put your money in? Well, you want to put it in things like real estate, commodities, energy companies. You want to be buying shares of companies that are producing those kind of things to build the economy, because they're the ones that are making profits or buying the actual goods or in demand commodities, because they're all going up in price, right? People are just buying things up. So that's what we call an inflationary boom, where the economy is running really hot, activity and price are both up. Okay, so now let's talk about another kind of bust. So this is what we call a deflationary bust. Basically, the market is just in a depression. You can think of this like the 2008 financial crisis, right? Everyone is losing jobs, economic activity is down, prices are coming down. It literally feels depressing, and that's why it's called a depression a lot of times, because no one is buying anything. No companies are hiring. So when you think about what assets will perform, well, if activity is going down and prices are coming down, well, everybody's profits, all the companies' profits are also going down as well. So that's why you usually see prices of the stock market really go down during a depression. And the only thing that's safe, if you think about it, is just government bonds, because something like the US government is still paying out interest even while businesses are suffering. And so that's really the only asset that you can buy in a depression type of environment where activity is down and prices are down as well. Now, the final one, this is sort of a different boom. Now, I like to think of this one as just everyone having a good time. It's called a disinflationary boom, also called Goldilocks on Wall Street. You can think of it like the 90s or maybe 2024, 2025, where prices are coming in down, but economic activity is pretty steady. So you feel like there's jobs are growing, everyone's getting relatively decently paid, and companies are just seeing a lot of profits in this environment. A lot of companies are doing well. And this is the best time for stocks, right? Because the shares in the stable and good companies tend to move up as they grow. And this is also around the time, because it's stable, you see a lot of innovation happening. And so that's why you tend to see things like tech stocks or AI stocks right now move up, because they're also growing and they're getting investments. Basically, it's just a great time for a lot of financial assets. So that's what we call the disinflationary boom, or Goldilocks, as we call on Wall Street, where prices are down, but activity is up. Okay, so all of these kind of fit into like a map of quadrants, right? These are the different economic environments. They're like seasons. So you have your inflationary bust, which is everything spiraling out of control. You have your disinflationary bust, which is where it's basically a depression. You have your hot economy, the inflationary boom, and you have the disinflationary boom, or Goldilocks, where everything's really stable and everything's really great, right? So you can use this as a reference to start to understand which assets perform better in different economic states or seasons. Now, the point is, it doesn't mean that you need to start studying the economy all the time, though it's helpful, and you can even strategically invest if you like that. It is fun. But the point is, you want to be prepared for different economic environments. You want your portfolio to be prepared based on what happens in the economy, even if you can't predict it. So as an example, if we take the 2008 financial crisis, which is definitely depression, this is a great risk example. So we have the S&P 500, which is the purple line. You can see that's going up, leading up to the crisis, just because economic activity was doing pretty well. But then the stocks dropped so hard during that financial crisis, right? Because activity went down, prices turned negative, and so profits were just declining for so many companies. Now, if you were all in on stocks, you probably would have suffered a 30 to 40% decline in your portfolio. Now, that's stressful for anyone, even if you really hold, right? And you're just more likely to sell at that bottom when basically everyone's equally depressed, right? And then you would miss that rebound in stocks. Now, what happens with you can see with bonds, so that's the blue line, bonds actually went up, just like, because that's the only asset that's safe, and they actually went up 40% during that period. So when you own both of these together, you kind of have like a protective buffer of risk in your portfolio. And that's why we put together different assets. Because if you put together both stocks and bonds, you'd probably be down only 10 to 20%, which is much more manageable. Because you have that safety buffer, you get to keep most of the returns that you have, the gains that you have from stocks leading up to the crisis. And if in case you need your cash, you can sell your bonds, or you can even rebalance by selling some of that bonds that have appreciated in value and just start buying stocks when they're a lot cheaper, right? So it can actually improve your returns over time. So this is the key investment principle that I want to share with you to build a safe portfolio, and which is the principle of diversification. You want to be prepared for all the different type of weathers of the economy. The point is you want to still own stocks because they give you the highest returns, which is why you're watching, but you also want to own different assets to diversify your risk. You want to position your portfolio to return even better no matter what the economic environment is. So how do we actually do that? Well, the first concept to understand is how prices move together, which is what we call correlations. So let's switch back to stocks just because it's easier to see with charts. So we have a price chart of Paylocity, that's the blue, and we have Paycom, which is the purple. Now you can see that these prices move very similarly, right? They're very correlated. And the reason why there is because they're very similar businesses. They both sell payroll software. They're very similar business models. They're in the same industry, in the same market. They're both in the United States, very similar businesses. So that's why the stock prices are basically almost the same. Now let's compare that with two different companies. So we got Paylocity again, that's the blue line, and we got NVIDIA, which is the chip maker, that's the purple line. Now these are very different businesses, right? We got the payroll software, NVIDIA sells chips for AI, so different industries, different markets. NVIDIA is a global company. Now you can see that these prices move very differently, right? They're not very correlated because they're different businesses, and that's why the stock prices don't move together. Now, mathematically, we can measure how prices move together using correlations. So here we have the two charts again, but different view. This time, we are comparing the monthly returns of these two pairs of stocks for the same time period. So we got NVIDIA and Paylocity on the right, and Paycom and Paylocity on the left. You can see that if we look at the monthly returns in the same time periods, the correlation, which is the R number over here, R equals 1, is just perfectly correlated. They're moving exactly the same. You can see that the returns are very similar for Paylocity and Paycom in each of those time periods versus Paylocity and NVIDIA is a lot spread out. So the returns are different. Now, here's the amazing thing. When you put together uncorrelated assets together, you can lower your overall risk. So when you put together things that are uncorrelated, so two uncorrelated assets together, the combined volatility or risk is lowered, and that's just because the prices are moving in different directions. Now, this is what we call the only free lunch in finance. You get to keep the returns, but your overall risk is lowered. Now, this is really powerful because if you put together 10 uncorrelated positions, your overall risk of your portfolio is reduced by close to 70%. And this applies to any type of asset or position that you have. It can be stocks, it can be different asset classes, right? So correlations are a tool to help you figure out what assets to put together to lower your overall risk. So let's put some actual numbers to this. Now, this is a correlation matrix for the past 100 years of the different assets that we looked at. Right? And so a couple things to note. We got our stocks over here, the S&P 500. Now, if we look at the correlations to other assets, you can see that treasury bonds is very low correlation. Gold is very low correlation, right? So when you combine these assets together into a portfolio, you're going to be reducing your risk, but still keeping most of the returns. And that's why you have bonds and stocks together, and also gold sometimes, to lower your overall risk, but still keep most of those returns from stocks. Now, what happens when you put all these together is, say we do this 60-40 portfolio, right? 60% stocks, 40% bonds. That's a very common recommended allocation. You can see that the returns are about 8%. So it's obviously a little lower than pure stocks, which is about 10%. But the volatility has gone down to 12% versus typically 20% for only stocks. And that's why the 60-40 portfolio is almost like a rule of thumb in finance of a balanced portfolio, meaning you've reduced quite a bit of risk, but still keep most of the returns. And that's why this allocation is so popular. So if you look at it together on a chart, this is a 50-year view of the 60-40 stock bond portfolio. The red line is the stocks over here. Black line is the 60-40 portfolio, and yellow line is the bonds, right? And so the point here is that the 60-40 portfolio just declines a lot less than only stocks. But for a good amount of time, you notice that the black line, right, the 60-40 portfolio is actually outperforming the all stock portfolio. And that's because when the low correlation of stocks to bonds actually reduces the downside, but you can still keep a lot of the returns over the medium term. And so that offers a reasonably good trade-off. You still get good returns, but you have much less risk of a crash, and it can even improve returns in some time periods because you can sell those bonds and buy stock when it goes down. So going back to the portfolio example that I showed you earlier, you can see that different combinations of assets can produce different risk and return profiles, right? Generally speaking, the more stocks that you own, right? So as we go down this list over here, you're getting more and more allocation to stocks. It's going to increase your returns, but also increase your risk, right? And so then when we add in the lower risk stuff like bonds, it reduces the overall volatility of the portfolio. So this is how you can start to design your own portfolio to create a risk and reward profile that fits your own situation. Now, when I talk about allocation, I just mean what percentages of assets that you're doing. Now, the basic principle here is that the younger you are, or the more risk that you can take, maybe you just don't need cash right away, you can start to increase your allocation to stocks, right? You can get higher returns because you can take a longer term time frame. You don't have to care so much about risk and volatility. Now, the older that you get, you probably want to be shifting more of your allocation to bonds, right? It's because you want to be preserving your capital. You have less of a time frame. And so you want to prioritize things like stability and income. So the framework here is just, you only really have three things or three parts to construct a portfolio, right? You have your risk, which is generally you can use volatility. You have your return or your expected returns of what you're buying. And then you have correlations to understand how they fit together. And you ideally want to put together combinations that reduce your risk but preserve your returns. And so that's it. You start to put these together, you combine them in a way to create a portfolio that suits your own financial situation. That's so important. So we're going to go over how do you actually pick a right allocation for your situation in a little bit. But first, let's talk about how do we actually execute all of this? How do we actually do this with the products so you can first see what it's like to actually put in money into real investments first. All right, so now we're going to talk about the products. How do we actually build a stock portfolio with the products that are out there? I'm going to show you how you can read some of the information and choose between different products as you go out and build your portfolio. Now, the good news is that there are tons of products you can use. You can get literally every type of asset on the stock exchange. So these are all ETFs, again, exchange traded funds. I'm going to explain to that in a second. It's just something that you can buy like a stock. And you have everything: cash bonds, corporate bonds, real estate, commodities, equities. Everything is on the stock market. Now, here's a quick primer on how funds work so you understand what you're actually buying. Now, what happens is the fund invests in different securities or financial assets, right? When I say securities, I just mean stocks, bonds, just financial assets. And then you own a share of the fund. Now, there are two basic types of funds. First is the open-end fund. Basically, it means that there's a flexible number of shares, and that changes based on the money invested into the fund. Now, that can include things like mutual funds, where you buy it directly from the provider, or an exchange-traded fund, or ETF, where you buy it on the exchange just like a stock that might come from a place like iShares. Now, a closed-end fund is when there's a set number of shares, and this is traded only on the exchange. Now, the reason is it gives the fund a fixed amount of capital. Typically, it's to invest in illiquid assets, in other words, things that don't trade a lot. And these shares can trade at a premium or discount to the fund's assets. So that's just something I want you to be aware of, to be mindful of when you're looking at these types of funds. Now, normally you're going to be investing in open-ended funds, so mostly mutual funds or ETFs, and they basically trade in the value of assets. But when you do look at closed-end funds, just watch out for the premium discount. You don't want it to be extreme. That's the basic kind of principle here. So I'm going to give you some examples of some stock funds so you know how to read the information and how to pick between the different products. So here's an example of an SPY. So that's the S&P 500 ETF index fund. So SPDR, or SPDR, is the fund provider. Now, what this fund does is it's meant to track the S&P 500 index. So remember, that's just the basket of the largest 500 listed companies in the US stock market. And this is an exchange traded fund. Again, you just buy it like a stock on the exchange. But because it's a fund, what it's doing is that it's buying up all the stocks that are listed in that index. Now, I bring up SPY, or SPY for short, because it's the most traded ETF for the S&P 500. It's the most liquid, the most easily tradable, and that's why it's very popular with traders and investors on Wall Street. Now, here's how it works. You can see its top holdings over here are companies that you could likely recognize, like NVIDIA, Microsoft, Apple, and usually you can look at the holdings in these funds to get a sense of what they're buying. Now, here you can see that the fund's holdings is basically the same as the index holdings, right? And that's just because it's a direct replication of the index. Now, when we look at indexes, they are usually what we call market capitalization weighted. Now, market capitalization just means how big the company is, meaning how much it's worth as a whole. Now, when it's market capitalization weighted or market cap weighted, you might hear that word, it just means that the bigger the company is, the higher the weight of it in the index. So notice over here we have NVIDIA. That is the largest company today by market cap. So that's why it's the top holding. So effectively, this fund is going to buy all 500 stocks, but proportional to their market value, right? Effectively, it means is you're buying more of or concentrating more of on the larger companies. And that's actually a good thing because these companies historically have actually tended to do better. Now, the alternative, if you start looking around at different products, is something called the equal weighted index. So that's where they're purchasing the same dollar amount of every stock. So that's just an option if you prefer not to concentrate on these big companies. But historically, the market cap weighted indexes have actually performed slightly better. So the next thing you want to look at is the returns. So this is the returns of the same fund, the SPY fund. And you can see that first thing we have is the market value. So that represents the value of the ETF, so the value of the fund's shares. And then we have something called NAV, which stands for net asset value. That represents the value of the holdings in the fund. Now you can notice they're exactly the same in terms of the returns, so there's no premium or discount, right? Remember what I said, that sometimes the value of the fund can diverge from the value of the holdings or NAV based on, say, trading conditions, and that leads to the premiums or discounts to the NAV or the net asset value of the holdings in the fund. Now, when we look at the market returns, historically, you can see that they basically match the benchmark, right? Because it's meant to give you the returns of the S&P 500 index, and that's the benchmark, right? So you buy this, you get the returns of the index, but minus a fee, and that's why it's slightly lower. And the fee over here, you can see, is the gross expense ratio. It's 0.0945, so it's very, very low. That's the percentage of the assets they charge every year. Now, the key thing to remember is that anytime you're looking at funds is you want to look at the performance of the fund net of fees. So that, i.e. after paying fees. And that should be standard in terms of the reporting, but it's always worthwhile to double check. And the other thing you can look at is the returns after tax, basically you want to look at whatever's the lowest return, right? Because that's probably what you'll get in practice. And here they are using the highest federal tax rate. We're going to get into taxes just a bit, but you can see that is probably what you would get as an after-tax return when you buy these shares. But overall, this is a great index fund because it gives you the returns of the index or the benchmark, and it has very low fees because it's just replicating the index. Now, let me show you another example. This is a Vanguard fund. Now, this is the VTSAX, and this is a total stock market fund, meaning it's a basket of all stocks in the US market. And I want to show you a Vanguard fund because Vanguard is one of the largest providers of index funds, and it has the lowest fees. Usually has the lowest fees. Now, the difference here from the previous fund I showed you is that this is a mutual fund. So you're buying this directly from Vanguard through your advisor or through your brokerage. So it's instead of buying like a stock on the exchange, you're actually buying it directly through from Vanguard. Now, when we look at the total market fund and we look at the holdings, you can see that the only difference is that it's buying all the stocks in the US market. Now, this index is also market capitalization weighted. So it's still holding larger proportions of the bigger companies. And that's why the holdings are basically all the same. And because it's all the stocks, they don't show it here, the percentage weight will actually be slightly different to what you saw in the previous S&P 500 index fund. Okay, so when we look at the returns, again, you always want to look at the returns. You can see that the total stock market returns for the U.S. Total stock market index is about 8.7% historically, right? So it's slightly lower than the S&P 500. Remember I said it's because the top companies actually tend to produce higher returns, at least over the past decade. And this fund, again, is also directly replicating the index. You can see that the VTSAX returns are almost exactly the same as the benchmark minus the fees. Now, notice that the VTSAX expense ratio, is really, really low. It's 0.04% versus 0.09 for the SPY. And you can see when they look at the other average, the average for other funds in that category can be as high as 0.74. So I like to bring up Vanguard because this is actually an investor-owned company. Technically, Vanguard is owned by their funds and therefore its customers, and it almost acts like a nonprofit. And so Vanguard almost always has the lowest fees. I mean, that's the mission of the company. So typically when you're buying index funds, you want to be looking at Vanguard because it will have the lowest fees, and that's why they're really great products. And there's also an ETF equivalent for this fund as well, so you don't always have to buy mutual shares. I'm going to explain to you when you want to do both in a second. Okay, now these are both called index funds because essentially they're meant to match the index, right? They're just buying the basket of stocks defined by the index provider. So in this case, it's the S&P, Standard & Poor's. There are other index providers like MSCI, and these index funds are considered passive investing, meaning the fund providers who make the fund that you buy are basically just replicating the index with buying those holdings in the exact proportion of the index. So basically you're meant to get the same returns of that index, of that basket of stocks. And because it's a completely automated process, there's no decision making. That's why it's called passive. It just replicates the index. That's also why they tend to have the lowest fees. Okay, so now in contrast, there is something called active investing. Sorry, it's a little hot. In contrast, there is something called active investing. And active funds are when you have a portfolio manager that is picking your holdings. So like this guy on the right. And they're designed to be different than the index. And that's sometimes called alpha if those returns are completely different from the index or market returns. So what this means in practice is that the manager is actually implementing their own custom strategy. Now, this could even be actually a computer-based strategy. But the point is they're trying to do something that cannot be done by the index. So let me give you an example over here. This is the Jennison Global Opportunities Fund. This is a mutual fund. I actually know these guys. I interviewed there. They pick like growthy companies. So when we look at the holdings of the company, you can see that they hold a lot of the same technology stocks, right? Because they're looking at growth, like Nvidia, Microsoft, and so forth. But you notice there's also international ones like Mercado Libre, there's C, right? These are e-commerce companies in Southeast Asia and Brazil. And so this means it's what we call a discretionary strategy. They're actually picking stocks. And so you notice, if you're very sharp, that there is also no Tesla here. So there's a reason why they're not doing that. Now, if we look at the objective of the fund, when you're looking at active funds, you kind of want to get a sense of what they're actually doing. So you can see that their strategies, they want to seek long-term growth of capital. They want to seek the best equity opportunities without any constraints. So that's the value of an active manager. You're getting a proprietary type of strategy. So the return should be higher or at least different because they're picking specific companies. So in this case, it's more growth, more international exposure. So you can see that they get much higher returns, but obviously a lot more volatility, right? But if we look at the past returns, the returns over the past 10 years, obviously that is starting to have an impact because they're getting higher returns. You can see the value of that portfolio of investing in this fund is a lot higher versus the benchmark, which is this orange line over here. But again, but it's a little bit more volatile because they're taking more risk. So when we look at the returns for this fund in more detail, we can see that they're getting between 12 to 13% returns annually over the long run. And that compares to about 10% for the global stock market index. Now that 2 to 3% might not seem like a lot, but remember, compounded over time, over and over and over again, those extra returns can really make a difference in the portfolio. And that's why you saw the value in the chart before in the prior slide was a lot higher for this fund versus the benchmark. The trade-off here for funds like these, active funds, is now you're paying a little over 1 to 2% in gross fees per year. So it's kind of high. And there's also this annoying thing like a sales charge. You want to watch out for these. And that's really the annoying thing about mutual funds, because that just means that whoever's selling it is going to get also a charge, and that's usually passed on to you, right? But this is, I would still consider a good fund, even with the higher fees, because it's got a defined strategy. The holdings are different. The performance is clearly different too. It's much better than the benchmark, at least over the past couple of years. And so you are getting a good return for the fees that you're paying. Okay, so now let me give you another example of an active fund. This is the DSU, the Debt Strategies Fund. So this fund buys loans. You can see all this stuff are actually loans. They're not stocks. They are loans for various companies or ETFs of loans. But because it's loans, it's actually quite difficult to implement with an index fund, because loans are kind of difficult and kind of a manual process, right? You actually have to have a relationship with a brokerage, which can get the loans through banks or from the market. You got to find the loans, you got to price them, right? So there's value in buying an active credit fund like this, because you can't get access to this type of product or securities without using the fund. So when we look at the performance, you actually get a really good return. It's about 8% or higher annually. And the thing is with this fund is that this return is actually in the form of income, right? They're paying out this amount of money because it's loans, right? They're paying out the interest that they're getting for the loans, and they also pay it out monthly, which is kind of cool, in my opinion. Okay, so when we look at something called the portfolio characteristics, this is something you want to consider for active funds. They're actually getting a 11% distribution rate. So that is the interest rate for the monthly payments that they're getting before taxes on those loans. And the reason why it's so much higher is because they are using leverage, right? They're borrowing money to buy more loans to increase the returns. And that's why it's higher than what's called the yield, which is the yield as a whole of the portfolio of those loans, basically the interest rate on the funds or on the loans that they buy. So again, you get a really great return and a monthly income source. So that's obviously why it's worth it, right? But the trade-off is you pay 2.33% in fees. So again, that's a percentage of assets every year. And that's how that 11% distribution actually turns into about an 8 or so return after you pay those fees. And so it's because it's much higher, but it's still much higher because it's a specialized product, loans, and it uses leverage. So in my opinion, it's still a really great product if you want to have access to loans for income, which I personally do. So the key thing when you're picking products, you want to do the exact same process that we just did there, right? You want to make sure you understand what the fund owns, understand what you're buying, understand the strategy of what the fund's buying. Then you want to watch out for fees. Obviously, low cost is better. And you want to compare it versus the returns. So you want to check the performance, look for the after fee returns versus the index or the benchmark, and really just be aware if this is a active strategy or a passive strategy, right? Understand the strategy. And if it is active, you may want to compare it with an index fund equivalent. See if there's a similar index fund that is doing a similar strategy. Compare the performance over time to see if it's worth the fees. And I would just say, lastly, active investing really is always a trade-off between having higher returns or different returns versus the index and getting access to a specialty strategy or product that you wouldn't normally do with an index. And the trade-off, of course, is you pay higher risk. You get pay higher fees, or there's more risk if the manager underperforms. So final thing to note when it comes to products is that fees are typically higher for mutual funds, especially if they use active strategies, because of things like those sales charges. And that's why mutual funds aren't that popular anymore. And they're also less efficient when it comes to tax. And I'm going to show you why in a second. And that's why I actually prefer ETFs overall. And I would suggest the same for you. But again, just the final takeaway is that treat this like any other product you're buying, like on Amazon, right? You want to be comparing options, checking what's inside, and really understanding what it does. And then when it comes to like looking for reviews, right? You can use something you can look for something called Morningstar, their ranking. So this is helpful for active funds. Really what Morningstar does is they compare the performance and the fees with other funds in the category. So you can look at how they rank. And that's just a quick check of the performance of the fund versus its peers relative to its fees. Again, you can look at that like a review and seeing whether or not it's a good product. Okay, so then if you are a complete beginner and you're just starting out and you don't want the hassle of actually looking at products, so just to start, I would just say this is a basic starter stock portfolio. I would suggest buying the S&P 500 index fund or a total US stock market index funds. And these are some of the tickers that you can use, or equivalent funds. Then I would add maybe a little bit of international stocks if you want to diversify, or maybe you can even add things like emerging markets if you want to maybe take a little bit more risk. And then also add a bond fund to diversify and lower your risk. Like we talked about before, you can either use a US aggregate bond index fund, or you can even use an international bond fund, right? And the tickers that I listed over here, these are the ETFs for largest ETFs for each of these categories. You can't really go wrong with these. These are all good providers, but you can also, I also said that you can also consider an equivalent fund, right? Like sometimes places like Schwab or Fidelity offer discounts for their customers. So just double check again, if you're looking into those kind of funds of the fees and the characteristics, really understand what you're buying, but sometimes those can be a good option as well. Last thing I want to note is that you can actually start right away to invest your cash lying around. You can actually invest your cash at the current interest rates on the market, right? Start getting actual returns on your money, even if it's just cash versus just letting it sit there with a very low savings rate at your bank, right? So for example, these are a number of ways that you can do it. In order of ease, you can do a high interest rate savings account. You can do money market funds or ETFs. You can do short-term treasury bills or ETFs, and you can also just buy treasury bills directly. So Apple, for example, offers a pretty high interest rate savings account. You can just open it on your iPhone. That's super easy. There's something called money market funds, which are essentially they're going to buy up treasury bonds or treasury bills, government bonds, usually short term because they're meant to be like a place to put your cash, and they can also get a pretty good return. Here's some examples from the biggest ETF providers, Vanguard and iShares. You can even buy a specific ETF that buys treasury bills. So this would be the iShares fund that buys 1 to 3 months treasury bills if you want a specific time frame. So you would just want to hold cash for that amount of time. Or you can even just buy treasury bills directly, right? You can go in and buy literally the treasury bill and get the exact return that the market is providing. And that's why you have a slightly higher return, right? You can see that as you get a little bit more manual, the rates start to get higher, and that's because all of these products, they're charging a fee for that convenience. But it is actually super easy to do things like buy treasury bills. So I'm going to show you that in the live demonstration. Okay, so now last thing on products is taxes. Now, how do taxes work with investments? And this applies to stocks, bonds, ETFs, mutual funds, anything, right? There's two ways that you can pay taxes on your investments. So first is the investment sales. So there's a capital gains tax. And the second is basically when you get a dividend or a cash distribution from the company, you pay income tax on that. Now, the way that investment sales or capital gains tax works is that you basically pay on the percentage of the gain of the sale, meaning your taxes are based on a percentage of the price appreciation when you sell it. Now, typically, it's about 15% long term if you hold it for over the year in the US. And then short-term sales are usually charged at a higher rate, and it's usually charged as an income rate, income tax rate. That's why it can be as high as 20+%. And then if you have any losses on your sales, those are usually carried forward, at least in the US, that can be that are automatically offsetting future taxes. Now, ETFs are typically more tax efficient for taxable accounts. I'm going to talk to you about different types of accounts in a second. It's just because of the way that they're structured, right? When you have a mutual fund, when the fund manager and you take out money and you sell it, the fund manager actually has to sell those shares. So they have to pay taxes on it. And that gets shared with everyone who buys that mutual fund. ETFs, you don't have to do that. So that's why it's usually considered more tax efficient. So you want to try again to default to ETFs when you can. And then the second form of tax is basically an income tax, right? If you're getting a dividend, maybe a distribution from the fund, you're basically taxed on that as if it were income, and it's based on your tax bracket. Now, one thing to keep in mind is that some funds like state or federal bond funds can be tax-free. Obviously, depends on when you live. And municipal bonds, for example, are tax-free from federal tax at least. But last thing I just want to note for taxes is that honestly, gains are gains, right? Like I wouldn't let taxes influence your investing too much. It's really a secondary concern. Best practice though, I'd suggest is just hold longer, right? At least more than a year. If you can, don't buy and sell stuff like crazy because that's when taxes become a hidden cost. And remember, short-term sales and income will have a higher tax generally than long-term gains. Tax advantage accounts are important, so we're going to cover that shortly. But first, let's talk about actually picking stocks. Okay, so now picking stocks. Now this is the great game. Picking stocks is how people get over 20% type of returns, and this is real active investing. You become an active investor and start to make money with your investment decisions. Now, to start off with, when it comes to stock picking, there are actually a ton of different strategies that you can learn and use to make money. Everything from trading price patterns to timing business cycles. Really, there's a ton of different strategies. I'm just listing off a couple here for you. There's no one size fits all strategy. That's the thing. There's lots of ways to make money. You just want to start to find what makes sense to you. You can really start to break down stock picking strategies into two fundamentally different philosophies. First is the technical perspective, and second is the fundamental perspective. So technicals is all about studying prices, and that's usually associated with trading. Fundamentals is tends to lean to studying businesses, and that's more associated with investing. And really, if you think about it, it's just a difference between trading versus the market versus actually investing to buy something long term. When you're doing technicals, what you're really doing is studying the behavior of the market. And that's why you focus a lot on charts or equivalent quantitative analysis of price. It's usually more short-term trading price changes versus other people in the market or participants. And if you're doing fundamentals, what you're doing is studying the business and its economics because you're focusing a lot more on the long-term investing, finding value and holding it so that it appreciates in value. And that's why you focus a lot on things like financial statements like you see here. Now, you remember that nurse who retired in just 6 years? Well, he went all in on fundamental investing. And now just to give you an example of what aggressive investing looks like, active investing. So he started off with 10K, right? He invested really aggressively, saved most of his salary, and then he started picking stocks, right? He did a combination of growth, value strategy. He was doing some timing of business cycles. And so his returns overall were about 40% annually. Obviously, it wasn't a straight line, but this is what he ended up when at the end, because he made some really good calls. And that's how he was able to retire in about just 6 years of really active investing. And he still does it, and he really enjoys investing. That's the thing. Of course, the disclaimer is he had one stock that went up 30 times, so it wasn't a smooth experience like this, but the outcome was the same in the end. I just want to show you what's possible when you really put your mind to it. Now, picking stocks is a very rewarding, but it's a very challenging skill that you can develop. Now, I actually teach a fundamental process in my education program to invest in individual stocks. And it really is just like any other skill, right? You get better with good mentoring and good with practice. And really what it comes down to is learning to identify good companies, valuing them, and making decisions. And the key thing I want you to know from all the things that I teach is that picking stocks is a process. You're looking for patterns, you're doing research, you're making decisions. It's a step-by-step process. And that's what we do on the fundamental side. And so what I typically recommend to people in our program is to look for quality companies. So these are businesses with predictable earnings. They have very high returns on the capital that they use, meaning their investments. And so what we really look for is very limited competition in a growing market that produces high returns. And what that usually looks like is they have something proprietary, meaning they own something that no one else has that is of value. And you can learn to start to find these businesses with research and analysis. I'm actually going to put out a free masterclass, which you can see. I'll put a link into it that you can take a look later in the description below, where we talk a little bit more about the strategy and how do you actually pick stocks, completely free. I'll just put it there in the bottom. And so I know this is very abstract, so I'm going to give you an actual example of a company that you probably heard of. So NVIDIA, this is why NVIDIA stands out as a high quality stock, right? If we think about it, it's definitely a best in class developer of advanced chips. And that's why when we look at the revenue growth, we can see that it's been above 15% historically, indicating it's a market leader. It's also got a proprietary asset, which is its CUDA platform. This is basically their platform for doing development and building with AI. And so when you look at how that translates into their financial statements, well, they have a gross margin, which is the profit on the product itself, of 70%, which is well above the peers' 58%. Now, finally, we see a growing and huge market for AI and data centers. And so when you add on the growth plus the proprietary asset, what that translates into is a really high return on capital, meaning NVIDIA, when they invest their own money, they're getting returns of over 100%, which is way beyond the industry average of 30%, meaning their investments in their own technology leads to 100% returns of profit on that capital or that money. And of course, that translates into a higher stock price, right? Because of the higher earnings, the high returns. That's why the stock has done super well, obviously. I mean, this chart doesn't even do it justice, but it's returned over 20 to 30 times in less than 10 years. So that just gives you a taste of what it's like to do fundamental analysis on companies. And what most people don't realize is that it's actually just a few companies in the stock market that are actually producing all the returns on stocks. So first thing to note is this is like a segmented chart of dividing the percentage of stocks by their returns. So it's basically 2% of stocks are driving all the returns in the market, meaning 2% of stocks are generating over 900% returns. And this is over a 40-year time period. So there's likely a misconception, you might think this, that a lot of successful investors are trading hundreds of stocks like crazy every day. In reality, what investors are doing, and they might study 100 stocks, but they only just invest in a couple of them. And so you really need to invest in just a few of these top companies to boost your returns. You only need one or two winners, really, and you want to avoid all these losers, right? It's actually a significant portions of stocks have terrible returns. So it's just avoiding the losers and finding the winners. I mean, that's my philosophy of picking stocks. It's all about the quality because you want to get those super high returning stocks. But again, there's a lot of ways to make money in stocks. And this is a beginner video, so I'm going to keep it high level for now. And let's get back to actually designing a portfolio so you can get started right away. Now it's time to put everything together and talk about how do we start creating a portfolio that's right for you. The goal here is you want to be tailoring your investments to your financial situation, meaning you want to be investing in a portfolio of assets that are best suited to you. It's just like a tailor giving you clothes that fits, and it starts with sizing you up. So the first thing to do is to define your goals and your risk tolerance. So here are some questions that you want to ask yourself. Like, what are my goals for investing? How long can I stay invested for? How much am I willing to lose from risk? What returns will help me reach my objective? And do I have any expected cash needs, right? These are helping you define your goals and your risk tolerance. And so in some examples of investment goals, maybe build up assets for retirement. Maybe you want to build up savings to buy a house. Early retirement, maybe you just want to build up some assets for your kids, or maybe you want to replace your income and get some more passive income. And it might be worth it to just pause here and write down your goals if some come to mind already. It's always nice to write down your goals. So I actually created an investment planning toolkit that you can use completely for free. It includes things like this as a questionnaire to help you define your goals and your risk tolerance, because I want to give you like really financial planning in a nutshell, right? It starts with goals, risk tolerance, return objectives, time horizon, liquidity, and so forth. And really the planner and what I'm going to talk to you very briefly here is helped you get clear on your financial situation and your goals so that you can start to define a portfolio that's right for you. And so here is now I really want you to start practicing thinking like an investor, because we want to start to build a portfolio that fits your situation. So that starts with first doing a personal financial audit. Now, what that means is you want to build a very clear picture of your financial situation or your household so that you can start to shape your finances to meet your goals. Now, there's really just 3 views of your finances. First is getting clear on the money coming in and coming out. Just understanding what's coming in, what's coming out, and getting clear on those exact amounts. That's like your current operations. Second is getting clear on your personal balance sheet, right? What do you own? What do you owe? Whether that's like real estate, stocks, credit card debt, right? This is like your current financial state. And the third thing is to define your cash needs. I call that your liquidity requirement, which is how much cash that you need to have lying around. And that's to help you plan for things like having an emergency liquidity fund, because you only want to risk things that you can lose. That determines what cash or firepower you have to invest. Now, this is a worksheet example from the planner of your assets and liabilities. So your financial situation really is a view of your assets, what you own, versus your liabilities, what you owe. Right? This is a personal balance sheet. Now, this is super important. The key to grow wealth is to grow this side, right? You want to make the left side, your assets, much larger than your liabilities on the right. Basically, you want your assets to grow faster than your liabilities. That's the whole point of being an investor, is to invest or allocate your cash in a way so that your assets grow larger or grow faster than your liabilities. That's how you improve your financial situation and grow your wealth and meet your financial goals. And so growing wealth really comes down to 3 simple things. It means buying more things like stocks that will grow in value. It means paying down things, liabilities that cost you money like debt. And then as a result, you start to build your net worth, where your assets start to be higher than your liabilities. And that translates into surplus or equity. That's your net worth. And financial wealth really just means having a lot of surplus, so that anytime you have to make a financial decision, you want to start thinking like an investor. This is capital that I have to allocate, and just ask yourself, is this going to increase my surplus? Will this grow my assets faster or more than my liabilities? So as a question, for example, it's like, well, do I pay down debt? Do I reduce my liabilities? Or do I invest in stocks and increase my assets? Let's start thinking about it like investing capital. Let's compare the rates of return. We have a 25% credit card interest rate. So that's like investing in credit card debt. Or we have a 10% expected return on the stock market when you buy stocks, right? So what do you think you should invest in, right? Probably the credit card debt, right? Because it's growing faster than the stocks. So it's better to reduce that first. That'll increase your surplus. It's because credit card interest rates are so high versus even expected stock returns that it's almost always better to pay off that high interest rate credit card debt first and then start buying stocks. And the corollary, of course, is if you need to preserve cash for expected cash needs. And so then that's a different situation. Now, this is the exact same strategy or mindset that Warren Buffett uses, just at a really, really big scale. He's constantly looking for ways to grow the assets of Berkshire versus the liabilities. So Warren Buffett basically borrows a lot of money. His liabilities come from insurance premiums, loans in Japan, but he borrows at very, very low interest rates. And then he invests it at a higher rate of return. So he usually buys companies that return between 7 to 8% over the long run. And so then he collects that difference, about 6% over and over, but he does it with a ton of money, and he does it over such a long period of time that he compounds that interest, that increase, over and over and over again. And that's how Berkshire has become such a huge company, because it's continuously growing its assets faster than its liabilities by compounding that difference. And so that's why his strategy is sometimes called a snowball, right? The compounding returns just makes the money get bigger and bigger and bigger. The surplus gets bigger and bigger. And that's why he has so much cash and why his net worth is so high. Now, if you want to create this effect in your life, you actually first need to have cash, right? And so that's the third step here for your financial planning, is you want to be able to understand your expected cash needs, plan for future cash needs, right? And there's a couple things to consider. You probably want to have some kind of emergency reserve fund, right? Cash savings of between 6 months to a year's worth of expenses. You want to check whether you need cash for things like debt repayment. And of course, you want to just plan out any expected inflows and outflows, maybe gifts, maybe you want to buy a house, and so forth. And the point is, you want to ensure that you have positive cash flow in the future so that you can invest. And you really don't want to get into any cash shortages, because that's when financial troubles start happening. So then the worksheet is all in the investment planner. You can later after this video, you can start to download that and start to get a clear sense of your financial profile and plan your expected cash flow. And so that once you do those steps, you'll actually be able to start to determine your investment capital, right? Like how much cash you can actually allocate to your investments. And so here's like a target allocation for income, right? 50% to living expenses, 10% to building up savings, 10% to debt repayment, 20% for investing, and maybe 10% for giving, right? And this is the usual order of priority. Take care of yourself first, build up your cash, and then start doing investing, either paying down debt or buying assets or giving to others. I would say this is like the ideal target for most people to have, essentially saving and investing about half of your income. Okay, so now that you've defined your investment capital, now you can start to create your asset allocation or your investment plan. And when I talk about allocation, it just means the mix of assets that you're going to use to help you reach your goals that suits your profile. So here's how you create an asset allocation plan. Really, there's just 3 steps. First is to target the return and time frame that matches your investment goal. Second is ensuring that the risk is within your risk tolerance. And then finally, that the investment capital considers your cash needs. For example, say someone is very conservative in risk, has a stable income, and wants to build up assets to about $1 million for retirement in 20, 30 years, meaning they can take a lot of time, but they still prefer stability. So that recommendation would maybe be the 60-40 standard stock bond portfolio, someone with moderate risk tolerance. So you get returns of about 8%, 12% volatility, and expect that to be 10 to 20 years, right? So you're taking slightly lower returns than only stocks, and by combining bonds and stocks in order to reduce risk to that 12%, right? The bonds are just there as a buffer, allow some flexibility. Maybe you need to buy a house, pay for education, right? And of course, you can always rebalance it and buy more stocks if bonds are going up and the market is down. So here's what it would look like to connect that asset allocation to that investment goal, right? You want to invest for retirement. You're targeting that 1 million in 20 years, starting from 10K, right? So this 8% return would compound all the way down for 20 years to a $1 million portfolio. And we need to target at about 7% growth in savings to achieve that result. And the nice thing when it comes to investing is that we're really only contributing about $570,000, but we're getting a net gain of about $480,000 based on these projections, right? So this is a conservative profile, a longer term time frame, but limited risk. Now, here's an example of, say, another goal. You want to save up for a house. So now we need a target of about, say, $500,000 in 10 years. So now we need to probably start saving a lot higher. So we target savings growth of about 10% a year. Some more aggressive starting point, about $25,000 in savings. Still use the same stock and bond mix because we still want to get an 8% return, but keep our risk relatively moderate. It's a medium time frame, so it's still lower risk, because we want to have that cash to buy the house at the end. And so then that's how we build up about $500,000 over 10 years. And even though we're contributing $400,000, it's a lot of savings. We're still getting a nice net gain of about $100,000. But notice it's obviously a lot lower because it's a shorter time frame. Now, another example, say this, you have a much higher risk tolerance. You're younger, you want to take more risk. Maybe you're going to learn to invest yourself. Over time, you might move to a very aggressive active portfolio, mostly stocks, individual stocks, maybe in some things like crypto or gold, like alternative stuff. And this is more likely for somebody with stable income, minimal expenses, a higher risk tolerance, and saving and investing aggressively to maybe build up assets for early retirement. So here's an example of a return projection for this person, right? So long-term returns are probably over 10%. And now this is a good result. We want to be conservative because it's not going to be a smooth line, right? But the overall point is this person is getting good at picking stocks, and it might even get some benefit from risky ideas like crypto. Now, the volatility will be a lot higher, between 30 to 40%. It won't be a straight line. Again, that's why we're using a conservative return estimate. But we can see that this person is investing super aggressively, right? Until they reach about $1 million a little after year 10, right? And because they're learning to invest well, they're using most of their savings to invest. And then once they hit that $1 million mark, well, they're going to maybe quit their job, maybe continue to investing, and maybe invest a little aggressively. That's why I lowered down the return, but still using the returns from stocks. But by this point, they're just, basically living off the, compounded returns, right? So they're not actually doing any savings anymore because the money from at this point is more than covering their expenses. They can live off their portfolio. This scenario is 100% possible. It just requires good active investing. So your overall risk tolerance is really going to define like what type of mix is going to be suitable for you, right? And this is a score from the planner. But the key thing is that depending on your risk tolerance, these are some of the suggested portfolio allocations that you can use. And it's really just a question of how much you need to save once you define your allocation in order to reach your goals. So again, this is all in the planner. You can download this for free. And this is how you start to plan your investment allocation, right? You consider the risk and reward of different assets like these, start to put it together into an allocation that matches your goals and fits your risk tolerance. And then you can start to do some projections, again, in the planner, estimate the returns of your portfolio, see how it can grow. And just to give you an idea of how you're going to reach your investment goal and your financial goal. And of course, this is an ongoing process. You want to be doing this regularly because you want to ensure your investments are aligned with your financial situation and any changing goals that you have. So this is just something to help with your planning and your thinking, right? And again, you want to start thinking about risk as a whole. You want to have a holistic perspective. So just an example for myself, right? When I had a job and stable income, I had a very high risk tolerance, right? I had plenty of cash to invest. I was taking a long-term view. So I was doing a ton of stocks, and I was also doing alternative stuff, single stocks. I was doing high risk bets. But once I started my business, right now the business is super risky. It's volatile income. So now I have a shorter term view. I have less cash. And so I started to invest more in bonds and credit, right? More income focused stuff in order to sort of offset the risk of my business, right? Because the business was so risky, I had to reduce the risk in my portfolio. So the second thing I want to leave you with is that you want to consider, this is why you want to consider your financial situation as a whole, because your investments need to be aligned with your personal situation in terms of your risk. So that's the point of all this investment planning. Really, you know that there's the whole opportunity here to build wealth in the stock market, but we want to start to invest in stocks in a way that fits your personal financial situation. Make sure it's aligned so you can start to create your own personal compounding machine that's going to help you get to your goals. Okay, so now we can move on to execution. I'm going to show you how it's all done in practice. Okay, now last thing, let's talk about executing your investment plan to buy stocks. Now, the first question that you might have is, what brokerage do I choose, right? There's so many brokerages out there. And so just right off the bat, I would suggest go with one of these big ones here, right? Any of these. And here's why. Because when it comes to a brokerage, you really want to be looking for three things. The first thing is you want institutional strength, right? Second thing is you want low cost and fees. And finally, you just want to make sure that it has the investment options that you want. So generally speaking, you want a large and reputable brokerage firm, and you want it to be insured, because you really don't want to have your money in a failed brokerage. And this actually happened with a company called MF Global. Second thing is you want to have low cost and fees. So commissions have got to be zero. For stocks, that should be standard in the US. And you also want to look for hidden ones, right? Check what the margin rates are. Look for any things like transfer fees, maintenance fees, things like that. And then finally, you can look for execution quality, right? There's something called a Rule 605 report. That's just to check that you're getting a good price when they do your trades. Now, all of the ones that I showed you before, because they're big, reputable firms, they all meet that criteria, and that's why I suggested them. And the thing is, if you're in the US, you're going to be really lucky because $0 is standard. And there's also rules to ensure the brokerage gets you the best price on the market. Now, finally, once all those two criteria are set, the final thing to help you choose is you want to basically have a broker that covers all the assets and products that you want. The variety of ETFs that you want to buy, or bonds, or even stocks in other countries, right? Or fractional shares as an example, if you want to start with a very small amount of money. Now, what I personally use, if you want to copy me, I use a mix. So I use Interactive Brokers. That's because, they have a lot of coverage. So there's all these products. So I do a lot of active investing there. The margin rates are very low. So that's nice to use leverage as well here. Again, very active investing. Schwab, because they have all these different types of accounts available. I do all my long-term investing there. They have all the tax-advantaged accounts, which we'll cover in just a second. And they have really good coverage of products. And then finally, Merrill Lynch. I get it because I use Bank of America as my bank. It's nice that it's integrated. There's access to the advisor platform if I ever need it. The tools are great. The research is great. And it's got a really good coverage as well because it's a global brokerage. And so I like to diversify the brokers that I use, and I even diversify the accounts. Like I use some accounts for different purposes, some for savings, some for active investing, some for income, right? And by the way, I know a lot of people like to use Robinhood, and I've seen YouTube videos of other people mentioning things like Webull or Moomoo, right? I don't have anything against some of these smaller brokers, right? They probably offer a lot of value, but I don't use them, so I don't want to comment them on too much. But I say just double check that they're insured and watch out for fees, right? Just want to be safe. Okay. And so now here's how you can start to save on taxes, right? So these are what we call tax advantaged accounts. Now, when it comes to the types of accounts, there's three different types of tax advantage accounts that you want to be aware of, at least in the US, right? And so first is the 401k. Now, what that is, how it works, is you don't pay any tax now, right? You invest in it using pre-tax income, so you don't pay any tax at the start, and then you only pay tax when you withdraw it later at retirement, right? Around 60, which is when the mandated time that you can withdraw it without a fee. And typically you're expected to have a lower income then, so you can get your tax savings, right? By the way, if you withdraw early, that's usually a 10% tax penalty. There are some exemptions, which you can check on the IRS website, like hardship, for example. Not a huge deal. And the final thing, just for 401ks, just if there is an employer match, just match it, right? Because that's just free money for you. It's a great way to save for retirement. The second thing is your traditional IRA. So this is the exact same structure for a 401k, but it's for individuals, right? Your 401k actually gets converted to an IRA when you leave that employer. So same deal, no tax now, you pay tax later. Again, same recommendation applies, use it for retirement. And then the final one is the Roth IRA. So how that works is that you pay tax now, but you don't pay any tax later. So you pay tax on your income, then you invest it, and you don't have to ever pay any tax anymore on the investment until you withdraw at 60, right? So all of these accounts can have a huge amount of tax savings over a long period of time. Like some people have done some crazy things with their Roth. Like Peter Thiel he's the founder of PayPal. He put his shares of PayPal in a Roth. Now it's like $7 billion. There's Ted Weschler. He's a Buffett portfolio manager. He was actively picking stocks in his Roth IRA, and he grew that to over $100 million over 28 years. So again, this is just an example of good compounding and good returns in action, but you just get the benefit of not paying tax, right? So that can really have a boost over time as well. So I use all three accounts, right? I have 401ks from past jobs. They've been converted to a traditional IRA, and I contribute to a Roth IRA as well. So the key thing here is if you have the cash, just take advantage of these accounts for your retirement. And just remember that if you have to withdraw early, there's usually a penalty of about 10%. Think of it like a long-term investing account. Use it for long-term investments, but you can actively trade it or invest it if you want. But I do suggest sticking to long-term investments for these type of structures because it is for retirement. So how do we make savings and investing as easy as possible? And it all comes down to putting it into a system to automate your investments in order to set it and forget it. So I'm just going to give you the strategy that I use to save, just a small percentage of my income, maybe 10% or so. And in just a few years, it was $100,000, right? The key principle here is do not let your cash for investments ever hit your bank account, right? Take things out of your cash or take cash out of your paycheck first. You can use it. You can do things like 401k, use your company share purchase plan, even healthcare savings account, or just schedule transfers, right? I basically did all of those things, maxed out the 401k, used a share purchase plan, put in money in the savings account, and also transferred regular cash to my brokerage. The key thing is that you never see money in your bank account. Now, what happened to me is when I only saw a few $1,000s in my bank, I just didn't spend that much money. So it was just a natural way to start saving, and it really just made saving really effortless. And so then once you do that, you just want to start to automate your investing and turning those savings into actual purchases of assets. So that means setting up an auto transfer of cash from your bank to your brokerage, right? That's just automating it to get to your brokerage. You can set up recurring purchases if that's an option, or you just make a schedule on your calendar just to start buying stocks. It can be quite fun. And then finally, you just want to review your balances to ensure that cash doesn't remain idle. Now, the thing is, it doesn't mean that you need to change your lifestyle, and force yourself to live on less, right? Because I was saving so much without even knowing it, anytime I'd want to take a trip, there's an event coming on, I would just check my share purchase plan to see if there's money there. And usually there'd be a couple $1,000s, right? So I just use it, sell that stock, go on a trip, right? So I basically use that one little share purchase plan as my little fun savings account, right? And all the others were for investments. And so that's how I was able to I was very surprised, built up to $100,000 in just a few years. So with no effort at all. So you'll be very surprised at how quickly your investments can grow as long as it's consistent and automated. Okay, so a couple tips to finally remember is that you want to maximize that 401k. That's basically free money. You definitely want to do that. Use any pre-tax saving options. Again, it's just an easy way to save. And then finally, make sure to set that allocation when you do your 401k, actually set it to invest in stocks or bonds, and do things like dividend reinvestment. So that just ensures that if a company pays you a dividend, you don't start building up that cash in your account. You want to keep reinvesting that. Basically, no cash left behind. So once you set that up, it's kind of like having a little piggy bank grow in the background. You start saving and investing your money, start building your wealth in the stock market with no effort at all. And you can still have the money to live your life you want. So I would definitely suggest implementing this type of system. Brain fart. Now let me give you a live walkthrough of setting up a portfolio. So here I have open my Charles Schwab account. You can look inside my Charles Schwab account. Obviously, I'm going to blur out all the values and account numbers and so forth. But once you set up a brokerage account, it'll look like this. So you see how we have our different accounts down over here. This rollover IRA is what was converted from a prior 401k. I have my individual account, which is just a regular brokerage account. Also has futures if I want to trade that. And then this contributory IRA is the Roth IRA that, remember, is just a post-tax contribution where you don't pay any tax afterwards. And of course, I have my investor checking account for cash. So now let me give you a demonstration of setting up some of those automated savings that I talked to you about. So on Schwab, one thing that you can do, and all the other brokerages, I imagine have something similar, is say we go to transfers and payments. We'll do online transfers. And then I will do transfer cash. So let's do my external account and let's transfer it to the contributor account. Okay, So now, for example, we have our contribution limits. That's we're going to select contribution year, and let's say I just want to contribute, 500 every month, and I'll just do it every monthly, right? And so we'll set up that transfer date, and I'll just press continue. So now I can set that up for every month at a specific date, and I can just set a reminder on my calendar, or just check it whenever you get the time to then allocate to your portfolio. Sometimes you just can't set up an auto buy. I think when you're doing mutual funds, sometimes you can set up auto buy. So you just have to check through your brokerage account just to make sure, how automated you can actually be. So let's go over actually putting on a trade with your account. Let's say we defined our allocation, which just means, again, the weights of the different assets in our portfolio. And in this case, I'm going to show you a couple of options where we have a moderately aggressive portfolio where we have 70% stocks, 10% alternatives, and 20% bonds. So let's start with the stock one. So here I'm just going to the all-in-one trade ticket where you can put in an order. And what you do is you just search the symbol, the ticker symbol, if it were a stock or ETF. So I'm going to do the VOO, like I mentioned earlier, which is the Vanguard S&P 500 fund. Now, so we're calculating we want 70% of, say, $5,000, a simple allocation. 70% would be $2,500. So I can just do 2,500. And then the current price is 622.65. So I'll just do that. And 665. And so Schwab makes it easy. They can just calculate how many shares you actually need. So we need 4 shares. And of course, we want to buy. And let me give you a quick tour of what these limit orders are, what these order types are. So first thing to note is that the order types just directs the brokerage on how to execute your order. And the big two ones are limit orders and market orders. So market orders, to start off with, say if I just did a market order, you can see that there wouldn't be any price showing up, right? Market orders just tells the brokerage to execute the trade at the current market price. Now, if you are in the US, there is regulation that the brokerage must get you the best price on the market. But it's still a risk, so I don't recommend doing market orders by default because, say, somehow there's some volatility, especially with like smaller stocks, and then if you put in a market order, you might get filled. Filled just means executed at a really bad price. So I always recommend doing limit orders. Now, limit orders just tells the broker that I only want to buy it at that current price. And you can also set the timing. So good till canceled will just have that order remaining. Sometimes it's handy if you just want to put in an order for a stock that you want to buy a little bit below the price, and you can just leave it there. And then these are just the general timing. So extended hours is just after the market's closed. And that can include AM or PM. And fill kill just means like execute it right away or just kill the order, right? So that's probably more of a trading thing. So let's say we'll do a day price. We want to buy about 2,500. So then I just review my order and waiting for it. Okay, so then you just get a confirmation page and I can just place that order. So I place that order and now it's going to buy that stock when the market opens. So it's really simple. That's how you execute a trade. Okay, so then once you put in an order, you can actually go to the order status page. All right, so when you go to the order status page, you can see all the different orders you have that have been put in. Now, because I put this actual order in and it will be executed when the market opens, I actually will want to cancel it. But say you want to change the price, see I just click change and then I can change the limit price. And so let's clear that. And in case I forget, I am actually going to cancel this order right now. So the brokerage doesn't actually execute it. Now let me show you a couple of other things you can buy. So let's say we want to buy that mutual fund that I talked to you about. So let's go again, put in the symbol. So that's PWJZX. Okay, so that's a mutual fund. You can see a mutual fund pops out. And again, we can just press buy. And another thing that I do recommend when you buy stocks is to put on the reinvestment. So here they're going to pay out dividends. And I guess if they have any capital gains, they sometimes would distribute it. So instead of just taking the cash, I do recommend actually reinvesting the dividend and capital gains. And so let's say we want to put in about 1,000 for this one as an allocation. And then I'll review the order, and it's just that simple. Then I can execute it, and the dividend reinvestment is going to be turned on. So another thing to note is I'm going to go back to my positions over here, and let's go to one of these tickers. So if you have a position already, usually there's a setting to turn on the reinvestment. So for example, here, I already turned all of them on, but here you can put yes and no to tell the brokerage that if that ETF or mutual fund or stock pays you a dividend, pays you in cash, then you just reinvest it. You can see I turned it on for all of them because I just don't want to have any cash lying around. Okay, so now let's start filling up our brokerage account and allocations. So we did our stocks. We also bought an international stock fund with the mutual fund. Let's say we want to get some bonds. So I'll do AGG. That is the core US bonds. So I can buy some of that. Let's say I want to buy 500 of that. Let's do calculator, 500, and we can apply. And so that would be our order for the US aggregate bond. And let's just cancel that. So I don't want to put that order in just yet. And say we want to have some cash just lying around. Here is another one, for example, SHY. So that's just a 1 to 3 year treasury bond ETF. If we just want to get some yield on our cash, and that should give us the same rate as the treasury bonds of between 1 to 3 year maturities. Okay, so now let's say we want to get a little bit more yield instead of just the bonds. I'm actually going to buy some credit. This is actually one that I own already. So let's look at the BlackRock Debt Strategy Funds. This is going to be buying loans, so I can buy that. And let's do a calculator. Let's put 500 and do that. And I can put in a limit order for that price. Okay, so there's also some special instructions that you can also do. These things I don't really play around with. I just let the broker execute it themselves. But say, for example, you want to get that whole allocation filled, and you can do all or none. That's just an order type to make sure like, hey, I want that entire order filled all at once. That's kind of a thing that's used by institutions sometimes if you want to just get a block in. Okay, so I can review that order. One thing to note for this BlackRock fund, there isn't actually any dividend reinvestment turned on automatically, so just keep that in mind. If I buy this fund, I will need to go into the positions like I showed you to turn on the reinvestments. Okay, so now let's start buying a couple other things. Now let's say I like this stock TradeWeb as my single stock allocation. I'm just going to put in 250 for that one. Let's go 250, and then price is 111 a share. And I can buy that. So let's review that order. We can put the limit price there. I forgot to press buy. And so now I'm buying about 250 worth or 220 worth of that single stock. Now, as another alternative, let's say I want to buy something a little bit more risky. I want to get some crypto, so I can buy the Ethereum crypto ETF. I also want to buy that, and let's put in the limit price. Let's get the calculator. Go 500, and so I'm also going to buy. What is it? I'm buying 13 shares of this Ethereum fund. Okay, right. So then we just execute trades for each of these things, and then make sure we turn on the dividend reinvestment. And so that's pretty much all you need to do to start setting up your portfolio. And then once you get everything set up, the nice thing is you can go to your summary tab and look at something like this. And then you can just watch your portfolio just start to compound up, you know? Mine has been going down because I have started to withdraw some money to fund some expenses.
running a business, take some money. But otherwise, you can see that this portfolio started to compound up, and it's really the result of both the reinvestments as well as the appreciation of those assets. And that's all you need to do, and you can get started right away to set up your brokerage account and set up your allocation.
The last thing to wrap up, action steps. I want you to get your investment planner. You can download it for free. Start doing your financial planning, set your allocation to stocks. I'm going to put together a detailed video to actually walk you through it. Second thing is, if you want to look into the actual strategy of stock picking through my education program, I have a free masterclass so you can learn about the strategy and get some tips. And then last thing is, if you want to keep going into this stock path and you want to learn about the fundamental analysis of stocks, I would also suggest looking into this next video. All right, so thank you for watching, and I will see you in the next video.
All right, let's buy some SPY. I'm going to do some SPY, and wait, did I sell?